Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, 𝗘𝗀𝗁, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, 𝗘𝗀𝗁.
Welcome in, 𝗘𝗀𝗁 with Real Estate Radio Live. Thank you for those that are tuning in on a regular basis. I'm going to let everybody know again to get started here that I will be doing these at least once a week. I thought I was going to be up and running again a couple months ago, but it took a while to get established again and get everything back in gear. So we are running again, up and going. We're going at least once a week with our podcast. We're great to be back with a lot of information to share. We got a lot of great guests coming. Just as a recap for those that may not have listened to the show for a while, and just a quick update, I've been doing the radio and podcast for 12 years now, over 1,700 interviews and shows. Many of those will be up on YouTube shortly. Going forward, they'll be on all the social media sites as well. We're going to try to get as much information as we can out to those when we can. For those that have been following me for the last 12 years now, you know the focus of the show is education and information. So what we do is work really hard to have great guests, information that we share with you, content to help you make wise financial decisions in and about your real estate. So that whether that's buying or selling a home, getting a mortgage, getting help with tax advice, financial planning, 1031 investment advice, we do all that here. I am primarily, most of you know, I'm in the mortgage business and have been helping people with residential financing for 23, 24 years. Do the podcast as well to get the information out, but I also have a great group of partners that I'm able to refer to that I trust at a very high level. So that means if anyone is out there looking for a real estate agent that needs to help you buy a home, help list to sell your home, do you need a CPA? Do you need financial planners? Do you need someone to help you with 1031 exchange? Anything, appraisers, anything to do with real estate. We have a team of people, part of my network, that I refer on a regular basis that I trust at a very high level. So keep those things in mind. For those that need to reach out for me, anything to do with mortgage you need specifically from me, or questions about real estate, or maybe you just have questions. I get a lot of emails during the week. And text as well. The way to do that, you can email joe@reradiolive.com. That is joe@reradiolive.com, or you can always text me or call me, area code 408-838-9060. That's area code 408-838-9060. So the topic today we're going to really spend the most time on is how low exactly do rates need to go to make a difference in the marketplace? That's what I want to talk a little bit about today, and a few other things, a little market update as well. So the question remains out there, and the one I threw out today, it's open for debate and discussion, of course. There's a lot of people with many opinions, is how low do the interest rates have to go for it to make a big difference in the marketplace? So let me take you back from where we started to bring you forward to make better sense of this conversation and this dialogue today. So as most of you know, 3 years ago or so, roughly, rates hit an all-time low. They were down in the 2% range for a while. It was just crazy to think. You could get a 15-year fixed in the 2.5%. There was even a point in time you get 30-year fixed in that money as well. So let's just call it down to 3% for sake of our conversation here. So rates went all the way down to 3% in general, a little bit lower, a little bit higher. Many millions of people took advantage of it, as they well should have, right? I mean, not only what the low rates did was spur a refinance boom across the nation, but it also spurred a ton of activity for purchase activity for people that are buying not only move-up homes, second homes, investment properties. Anyway, it spurred a lot of activity because the cost of money was so low. Rates came down as to that point. People took advantage of it. Fast forward a couple of years. What most of us wouldn't have been in such shock with is if those rates at 3%, say, or 3.5%, let's say they went up to 4.5% or 5% even, wouldn't have been so bad. But over a short period of time, they went from 3 to 4.5 to 5.5 to 6.5 to 7.5. And there's a point there, several months ago, the rates were over 8% for 30-year money. They have settled back down now as we speak today. Today is February 21st, 2024. Rates right now, the 30-year conforming rate, again, in general, these are general terms. A lot of it depends on your credit score, loan to value, a lot of different factors. But in general, the market rate right now, would probably be in the high 6s to low 7% range. Again, it depends on factors. That rate could be a little bit lower or higher depending. So what happened? Why did this drastic paralyzation of the marketplace take place? Simply said, rates went up so fast in such a short period of time, it basically not only stalled the market, the real estate market, and a lot of movement in the transactions that go with it, but what it did was it paralyzed the consumer. It paralyzed the consumer. If you could imagine, and most people, if you really take a few minutes to think about this, if you're looking at your interest rate, your mortgage statement, you see a 3% interest rate, and then now all of a sudden you're looking in the marketplace, you're seeing a 7.5% to 8% interest rate. That is a shock to the system. So it not only paralyzed the economy, but it paralyzed the consumer. So there's two different things. Now, one might say the consumer is the economy, and I guess you can make a case for that. But I would say maybe it paralyzed the financial markets and it paralyzed the consumers as well to really, what should I do now? So what happened, there's this big kind of pullback, withdraw, if you will, with consumers and financial markets. And what does this mean? And where's it going to go? And, how long is this going to take? And what are we going to do to recover? So there's this point of disbelief and frustration and paralyzation. And so we've gone through that over the last year or so now. In 2023 will go on record for me, and I think for most people in the mortgage industry, is probably the worst industry since I've been in it. Some people may relate it back to 2008, 2009. I would say this is much worse. And the reason why is rates weren't as high, number one. And to be honest, we still had a fair amount of business. I mean, business was slow for me in 2008, 2009, but it wasn't paralyzing and down to this drastic effect that it was for 2023. Late 2022 and 2023 were flat out terrible. And most people in the mortgage business and some in the real estate would tell you the same. There just was enough transactions to go around to support the millions and millions of loan officers and people in residential lending and real estate for the little amount of transactions that were taking place in the last, say, 12 to 16 months. So what is 2024 as a look ahead? What can we expect? Well, I follow this on a regular basis. I cover this, part of doing my show, I do a lot of research, and I have for 20 plus years, specifically the last 10 or 12 years. I do research every day. I read a ton of articles. I listen to podcasts. I listen to experts in the mortgage market and the financial markets and how it's going to affect these things. So what I try to do is pass this on to you and educate and inform you to make wise decisions in and around real estate, as I said before. So that's my job, and that's what I do on the podcast. So what are we going to look like in 2024? Here we are. We're sitting in February 2024. I think that we're starting to turn a corner ever so slowly. This is my opinion, and this is what I'm going to hold to. And of course, the great things about podcasts, you go back and say, hey, look at that, I was right. Or you go back and say, gee, I didn't call that correctly. And I have to own that. So here's my take based on the information I have and as I see things going forward. I think we're slowly turning a corner. I do think that the Fed is done raising interest rates. Okay. I'm pretty sure unless something happens we don't know about, the Fed is done raising. So that's the first part. The second part now is, when will the Fed start lowering the interest rates? Well, most people would say, I don't know for sure. Some people would say maybe March and April. Others might say May or June. I think you're somewhere, both of those statements are correct in some senses. I would say that we could probably expect, unless something happens we don't know, I think we could definitely expect rates to start coming down in the May to June month time frame. If they come down a little bit sooner, that would be great. But I see May to June time frame. And I think by fall, by the end of summer, early fall, we will see rates, I hope, I don't know this for sure, but I hope that we see rates back in the 5% range. That could be 5.5%, that could be 5.75%, that could be just under 6%. My opinion. So the title to this article today is how far do rates have to come down to make a difference in the marketplace? So the answer to the question that I have for that very question is, I think they need to be back in the 5s. I really do, to stimulate the market to get it where it's going to move. So right now, if we're in the high 6s to low 7s, I really do think we need another 1%, a little bit more, maybe 1.5% pullback. My belief is, and I want to prepare those that are getting ready to maybe move up buyers, sell your home, buy investment property, refinance. Keep an eye on May to June right now, and certainly maybe late summer, early fall. But I'll start calling maybe a move downward in May to June. If it happens sooner, that would be great. I think we'd all be happy. So my opinion is, once we get back into the 5, 5.5, somewhere in that 5 range, it has to be below 6, in my opinion. Once the rates drop below 6 and people can start getting 30-year money in the low 5s or mid 5s, I do think that will stimulate the economy. I think it'll reactivate, if you will, or get people moving again. I think they'll create a ton of move-up buyers. I think it'll create, no doubt, that it'll create a lot of refinance business. And some people might say, well, Joe, how is it going to create a lot of refinance business if someone still has a rate for 3%? That's a great question. I'll tell you why it's going to affect a lot of people. So here's the reason. When you say these millions of people have rates in the 3%, that's correct. That is true. They do. But here's what's happened over the last 3 to 4 years, and maybe it takes a little longer. Because those rates were so good on those homes, people didn't dare touch them unless they had to. So if you needed money over the last several years, where did you get that money if you couldn't get it out of your mortgage? You got it from home equity lines. You got it from credit cards. You got it from personal loans. You got it from auto loans. You got it from different things like that, right? Well, right now, home equity lines are based on prime. So if you have a home equity line and it's just, say, prime, it doesn't even have to be above prime. Most of them are prime plus 1. Let's just call it prime. Prime right now is 8.5%. That's the prime rate right now, 8.5%. Okay. So if you have, say, $200,000 or $300,000 on an equity line at 8.5 or 9%, and the rates come down to 5.5% or the low 5s, you are now going to be effectively looking to refinance your home, pay off that home equity, roll those into one, and have an all-encompassing 30-year fixed or a fixed rate mortgage in the 5% range, because now it makes sense. And let me take just a couple of minutes to explain that. Someone might say, well, Joe, why does that make sense if you have a 3% rate? Well, you have to blend the rates, right? So let's say you have a $300,000 loan at 3%, and you have let's just say a $200,000 loan at 9%. Okay. So your effective rate, you're paying 9% on 200,000, you're paying 3% on 300,000. If you blend those together, you're going to be saving money. If you combined the $500,000 loan at 5 to 5.5%, you will be doing better than you would at paying 2 separate mortgage payments, the one on the 3% of the 30-year and the home equity line of 200,000 at the 8.5, 9% interest rate. You just would. So the combined rate of, let's call it 5 to 5.5%, is a better cost of money and is going to save you money versus splitting the two and paying a portion at 3% and a portion at 9%. It just is. So it's going to be better. So this is why it will also spur a refinance market when the rates get down in the 5% again, because then that will be an indication that now you could borrow money cheaper effectively than money's been out there the last 3. See, once you have an economy that is used to 7.5%, 8%, that's just what it is. We get used to it. We do. Again, I talked about the shock factor earlier. That happens. Paralyzation, that happens. But then we get used to it in our environment. We get used to it. So now all of us have been used to 7.5%, 8% for a couple of years. We'll get used to it. Doesn't mean we like it. No, but we get used to it. We conform, we adjust, we budget, we analyze, we do it based on 7.5 to 8%. Now, once those rates come back down to 5, then we'll relook at what we need to do. So that's why it'll spur a lot of refinance business when they get back into the 5s, and it'll also spur a lot of purchase activity. If you have a person that is in their home right now and they're really thinking about being a move-up buyer, let's say they own a home and it's worth $1 million and they love this idea of moving into another neighborhood, maybe paying $1.5 million, so maybe a $500,000 upgrade on purchase versus what they have now, or even $2 million, maybe a double. Well, that's a tough move when you have a 3% interest rate. It really is. I mean, let's face it, unless you have a dream home or a dream situation, or you're flush in cash and you don't have to worry about cash and you don't mind your payment doubling or tripling. Even people that have the money are pausing, and I don't blame them, of being a move-up buyer or doing a transaction when they're sitting there on a mortgage at 3%. I understand it. I get it. I really do. And it's basic economics, ladies and gentlemen. It is. So that is the answer to the question of the podcast today. How low will rates need to go? How far do they have to come down before it'll stimulate the market and make a difference? My estimation, and I'm saying somewhere in the 5s, ideally the low to mid 5s. I think the activity will start spurring once it drops below 6. But if we could start getting people rates back into the 5% market, we'll see stimulation. We'll see an uptick. Probably we'll see a 30 to 40% increase in activity, and not only home selling, home buying, refinancing. We'll see a huge market. We will see all of a sudden the mortgage and real estate market, I do believe, increase anywhere between 30 and 40% where we are today. And some people might say, wow, really? I said, yeah, because we're pretty low right now. I mean, the numbers in the transactions and units are very low right now. And by the way, the only reason most popular markets are keeping their home value, I can tell you the only reason is the inventory is low. That's the only reason. If inventory was high, and if we get to a point where inventory doubles and triples, mark my word, I guarantee you, those values will come down, and they'll come down at least 15 to 20, maybe 30%. So let me give you an example. Santa Clara County, for the first time, and I think I'm correct on this. I follow this on a regular basis. Santa Clara County, for the first time in this past week, inventory in Santa Clara County just went over 1,000 units. Just went over 1,000 units in the entire county of Santa Clara for the first time in a long time. So what does that mean? What it means is inventory is growing a little bit. So you might say, Joe, what's a healthy and unhealthy inventory rate for something like Santa Clara County? Well, I could tell you there were times in Santa Clara County, the inventory is down to 500 or 600. I think I've seen it as low as 500, maybe even lower for a short period of time. So in essence, inventory now is over 1,000 for the first time in a long time. That looks like a trend. Now we're going to have to see where that trend goes. Does that trend flatten? I could tell you in the next 30 days, if we go from 1,000 to say 13 or 1,400, I would say that's a trend. And if that trend is on its way, I would say this to both homeowners, potential sellers, and buyers, because it'll affect you differently. Now listen, it's going to affect the buyers and the sellers differently. See, if I'm a buyer, I want a lot of inventory. If I'm a seller, I don't want a lot of inventory. Does that make sense? Because if I'm a seller, I want less inventory. That means I have less homes for people to bid on, and likely that people will keep that price level strong for my home. Just want to explain the supply and demand here, the way this works. So if you're a potential seller, you might want to be careful, and I would get ready to put your house on the market pretty soon if you see a trend where homes are starting to come on the market at a fairly rapid rate. Again, this is not to shock you. This is not to alarm you. It's just to educate you. If you are a homeowner, all right, and you're thinking about selling your home and you're wondering the right time to do it, you should watch the market, talk to your real estate agent, call me if you need any assistance or support in that. Again, I could refer some great agents. I have been part of my network. You need a good real estate agent to keep an eye on the market. Here's why. If we're at 1,000 right now and you're thinking of selling your house and you're seeing, let's say by March or April, you're seeing now the inventory tick up to 12 to 1,300. I'm telling you, it'll make a difference on what you get for your home. The more homes go on the market. It's common. It's economics, ladies and gentlemen. The more homes you have in the market, the less you're going to get for your home. Now, do I mean that's across the board guaranteed? No. But in general, more supply, right? You have more homes, you're going to get less for that because there'll be more competition. All right. Conversely, if you're a buyer, you're excited about the thought that inventory is increasing if you're a buyer. And the reason why is because now you have more to choose from, one. Two, the likelihood that you're going to get a better deal is more likely because you have more on the market. You have more inventory to choose from, more competition. So this is always the dilemma. So the message I want to get out today before I finish up, and I'm encouraging you when you're listening to this podcast, please give me an email, shoot me a text, joe@reradiolive.com. Better off, text me, call me, 408-838-9060. I'll give you updates. I'll give you reports. We could have a conversation. We could, put together a strategy. When is the best time to refinance your home? When's the best time to buy a home potentially? When's the best time to sell your home potentially? Follow this podcast and contact me, reach out to me. We could send you regular reports. We give you information. We are about to come into a market for the first time in about 3 years that you really will have to be more strategic about your decisions. There hasn't been much strategy to take place in the market in the last 3 years. And when I'm talking about that, the real estate market, there will be coming here around the corner, I would say, as we get into spring and summer, there will become, right now we're maybe coming a time when they'll need a strategy about whether it's a good time to buy or sell a home or both. And we're going to help you with that. Remember, inventory is at 1,000 roughly in Santa Clara County. And if that ticks up and looks like it will, we'll keep an eye on it. It may not. But let's say we're sitting here a month from now and now inventory is at 12 or 1,300. If I were a potential homeowner, again, thinking about selling your home, I would get it on the market in March or April and try not to wait till the summertime, because the summertime could really bring inventories maybe up over 1,500 or 1,600. Before I move on about this, I want to answer the other question a lot of people might have. Joe, what is a healthy market? What is a normal market for homes on a market in Santa Clara County? I will tell you, in an average market, all things being equal, but a county the size of Santa Clara County, an average market would see about 3,500 homes on the market. That's a normal market. 3,500 homes on the market. That's a normal market. So you see what's happening here? We have 1,000 and we're still super low in inventory. So we're turning the corner. We're on our way back. I feel strongly about it. I'm excited about what's going to happen here in the next 6 to 10 months. I will tell you that I think the latter part of 2024 is really going to start picking up steam, and then we'll start seeing some great activity towards the end and in the beginning of 2025. But you have to be prepared. Too often people, what they do is they wait till everybody else is doing something and they're 60 to 90 days late because they're not tracking and taking a strategic move. I'll finalize with this as I wrap up the show. We're turning the corner. I would think that in the next 3 to 4 to 5 months, we're going to have interest rates back down in the 5% range. I think by summertime that'll happen. If it happens before, that would be great. It may be a month or so before or after. That's going to spur activity in the marketplace. So I would say if you're a potential seller, be aware, be prepared. I would get your house on the market sooner than later, because you could fall into a trap and, get your house on the market kind of late. And if the inventory is real heavy, you're going to have a struggle getting getting a strong price. If you're a buyer, you're getting excited about this potential market because you're going to potentially get a better deal on a home and you're going to have more inventory and the rates are going to be better. Now, I'll have to say also, if you're a seller or a buyer, I'll get into this in the next podcast. You can be more strategic. There's a way that you could buy before you sell. And I'm not going to go into that today. I've done it before in a bunch of different podcasts. There's a buy before you sell program. I've done it for hundreds of people over the last couple of years. It's a great program. It allows you to buy a house without selling your house and do it strategically and cost effectively for those people that are concerned about selling their home before they buy a home and vice versa. So as we wrap things up again, I think we're looking at maybe a 5 to 6 month time frame. Keep an eye on the market. Always keep informed. I'm a fan and proponent of education information. That's what the show will give you on a regular basis. If you want to reach out to me, Joe at 𝗓𝗡𝗎𝗓.com. That's Joe at 𝗓𝗡𝗎𝗓.com. Or you could also reach me at 408-838-9060. That's 408-838-9060 for those home buyers. Lastly, if you're a first-time home buyer, there's never been better programs out there. First-time home buyer programs, 0 down, 5% down, 10% down, even up to $1 million or $2 million. There's some great programs out there. Don't let the high interest rate scare you if the timing is right for you. All right, as we wrap things up, thanks again for tuning in. Remember, you could always go to RERL-live.com. That's RERL-live.com. And we will be back with you sometimes next week. Keep an eye out for our podcast. Download our podcasts at iTunes, Stitcher, any of those places you could download the podcast. Follow our show. We'll be back with you next week. Until then, take care.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.